Hello everyone. Today we are going to talk about property and casualty insurance. Among all the property and casualty insurance, the auto insurance is probably the most common insurance, and it's probably also what you know most. First part of auto insurance is liability insurance. Liability insurance provides coverage for the driver's liability to others when the driver injures another person or damages another person's property. If a case goes to court, the insurance company pays legal costs. Policy limit is the maximum that the insurance company will pay, but does not include legal costs. The policy limit for bodily injury is usually higher than that policy limit for property damage. Liability insurance is required by all jurisdictions, meaning if you have a car, you have to buy at least the liability insurance. I'm sure for those of you who owns a car, you probably know this already. The second part of insurance, uninsured and underinsured motorist insurance. An insurer receives payments from the insurance company for damage or injury from another driver who is uninsured or underinsured. The third part of auto insurance is collision insurance. Collision coverage pays the policyholder the amount needed to repair the car. There is a deductible associated with it. It means that the insurance company pays the amount above the deductible. If the loss amount is less than the deductible, the insurance company pays nothing. Policyholder has to pay the deductible. The fourth category of auto insurance is comprehensive insurance. Comprehensive insurance pays the policyholder for losses with causes other than collision, such as theft, hail, fire, and vandalism. If you are financing or leasing your car, your lender likely requires comprehensive coverage. If you own your vehicle, it's an optional coverage on your car insurance policy. Now let's look at this example. Minnie Driver has an automobile insurance policy with the All Province Insurance Company. She has $200,000 of third-party liability coverage, bodily injury, and property damage, and has a $1,000 deductible on her collision coverage. Minnie is at fault for an accident that injured B. Jones, who is insured by Red Deer Insurance Company. Minnie Driver is successfully sued by B. Jones for Jones' injuries. The court orders Driver to pay Jones $175,000. Other expenses incurred are legal fees to All Province on behalf of Driver, $45,000. Collision costs to repair Drivers, $20,000. So first, the court ordered Driver to pay John $175,000, which is less than $20,000. So it will be paid in full amount. Then legal fee will be paid by the insurance company. Then the third one is collision repair is $20,000, but there is a $1,000 deductible. So $1,000 deductible will be paid out by the insurance company. The other $1,000 will be paid by the Minnie Driver himself. So the insurance company will pay $175,000 plus $45,000 plus $20,000 minus $1,000. So it will be $239,000. This is how much this amount that will be paid out by the insurance company. Now let's talk about homeowner insurance. There are different insurance within the homeowner insurance too. We're not going to talk about every feature. So here, let's just talk about the deductible in the homeowner policies to eliminate small claims. This deductible may be defined as a disappearing deductible, which means that the deductible disappears after the loss reaches a certain level. Let's look at this example. A homeowner dwelling policy has a deductible of $250 for claims up to $1,000. Between $1,000 and $2,000, the deductible disappeared linearly, so that for claims of $2,000 or more, there is no deductible. Determine the payment that will be made to the policyholder on a claim of $1,200. So first, let's draw a graph for the deductible. So if the claim is $0, your deductible is $250. It will remain this until it gets to $1,000, 1K. Now after that, deductible will drop. It will be 0 if you reach 2K. So if it is 12K, there will be this much deductible. It's a linear relationship between 1K and 2K. So based on this, we know this the ratio of this to this would be the ratio of this part to this part. Writing it if we assume this is D, deductible is D for 1200K, we know D, the ratio of D to 250 would be equal to the ratio of this part, which is 2K minus 1.2K, 1200. This over 2K, the whole thing is 2K. Whole thing is 2K minus 1K is 1K. So from here we can get D is equal 200. Based on this, we know the payment would be 1200 minus deductible 200, which is $1,000. So this is not a difficult question, just need to understand what it's asking and write out the equations and solve the problem. Again, there are lots of features in the homeowner insurance, and this is just a very limited discussion on this small claims, eliminating small claims by using the disappearing deductible. Please read the book for other information regarding homeowner insurance. Another topic we want to talk about for homeowners insurance is the co-insurance clause. Co-insurance clause is a homeowner policy is subject to co-insurance clause, which limits benefit to policyholders who do not select a policy limit of at least 80% of the house value at the time of the loss. By the co-insurance clause, the benefit paid to the policyholders is the loss multiplied by the ratio of the policy limit policyholders selected to the policy limit required by the co-insurance clause. So if the payment is calculated using the loss, it will be like this: payment will equal loss times your selected policy limit over your required policy limit. If you carry less than full coverage, usually at least 80% house value at time of loss, then the benefit paid to the claim is based on the prorate. So this is just telling you that to calculate the actual payment, you have to prorate it based on the policy limit that the policyholder select. Now let's look at this example. Mr. Fixit purchases a homeowner policy with an 80% co-insurance clause. The home is insured for $150,000. The home was worth $180,000 on the day of the policy was purchased. Lightning caused $20,000 worth of damage. On the day of the storm, the home is worth $250,000. Calculate the benefit payment Mr. Fixit received from his policy. So, required policy limit in this case is required policy limit will be 80% of this, because the home value on the day of the storm is 25,000, so required limit would have to be 200,000. But since the home is only insured for 150K instead of 200K, it means the benefit, the payment that Mr. Fix get wouldn't be full 20K worth. It will be the proportion of this 150K over 200K. So it will be 15K. So first you need to calculate the required policy limit based on the home value at the time of the claim, which is the day of the storm. Then you use this required policy limit to calculate the ratio between the home insured limit over this limit, which is 3/4, and this would be the ratio to use to calculate the actual payment. Since the damage is 20K, so 20K times 3/4 would be 15K. Now let's look at another example. A homeowner has a house valued at $300,000 but has insured for $200,000 with an insurer that required 80% of full coverage before it reimburses losses in full. The homeowner has a loss of $40,000. How much will the insurer pay? So the house has a value of $300,000. 300,000 times 80% is required. And what did the policyholder insure? He selected 200K. So this 200K over 240K is the ratio that should be applied for the loss. The loss is 40K. So you can get final value to be 3333. This one is very similar to previous one. First you calculate the required, then you calculate ratio, then you apply the ratio to the loss. In this slide, I just want to talk about a few kinds of deductibles. Some of the deductibles we already talked about before. So first deductible, fixed dollar deductibles or ordinary deductibles. This is just a regular deductible. That's the most common deductible we use in our insurance. Then there's a fixed percentage deductible. In this case, you calculate the deductible based on the percentage rather than the dollar amount. Then the third one is disappearing deductible, which we just had an example earlier. The deductible itself is proportionate between the dollar amounts. The fourth one is franchise deductible. We kind of touched on this before too. It means that if claim is less than the deductible amount, there should be no payment. If claim is greater than deductible amount, there's no deductible, so it pays the full claim amount. So franchise is either you pay full or you don't get paid. It's not like the regular deductible where if you get paid, you get paid by the claim minus the deductible. And then fixed dollar deductible per calendar year. This is usually used for health or medical expense insurance. We call this annual deductible. And the last one, elimination period, common use in disability insurance or health insurance too. Disability benefits are not paid for the first 30, 90, or 180 days or some other numbers. This is to eliminate the people who had a disability claim. They just if they have an accident, they just purchase the insurance right after the incident. Then they can claim for they are trying to claim for the disability insurance. But if there's an elimination period, then you cannot do this. You cannot say I have a problem and I report to claim for my insurance money right away. You have to wait 30 days. So the elimination period is just to avoid people trying to take advantage of the insurance. Now let's talk about policy limit. Policy limit refers to the maximum amount that the insurance company will pay. If there are both deductible and policy limit, we apply deductible first and policy limit last. So let's look at some examples. In each of the following cases, what will be the insurer pay on a claim of 12,000? A. A 20% deductible and a policy limit of 12,500. In this case, policy limit is way bigger than the claims, so the deductible will just be applied anyway. So first we apply deductible 12K times 80%. We got 9,600. This is less than the policy limit of 12,500 anyway, so you will get this amount. The second one, a straight deductible of 1,000 and a policy limit of $10,000. In this case, we don't know whether whether this 10,000 limit will take effect or not, but we can calculate based on the rule apply deductible first and the policy limit last. Deductible first, we got a 12K minus 1K, deductible is 11K, which is greater than 10K. So in this case, you will only get paid 10K because the claim after deductible is still greater than the policy limit. Now the third one, a linearly disappearing deductible such that a claim of 5,000 has no loss payment, but a claim of 15,000 is paid in full. Again, in this case, we need to draw a picture. So in this case, 5K is the threshold whether you get the deductible or not. If it's more than 5K, you will get some deductible until you get to 12K, 15K, then you will not have any deductible. Deductible will be zero. But now, since it's disappearing deductible, the 12K will be in between. Again, we just need to write the equation. We know the ratio of this to this is the ratio of this to this. Assuming this is D here, so we have D over 5K. will be equal 15. This part is 15 minus 12, and this part is 15 minus 5. Then you can get the D is equal, let me see, D is equal 1500 or 1.5K in this case. Then we will pay 12K minus 1.5K, which is 10,500. That's the amount of the payment. Now let's look at this last example. A risk-averse decision maker is faced with a random loss that has a uniform distribution over an interval $0 to $10. If he wishes to pay a premium of $2, then the optimal coverage requires a deductible of $D. Assuming no expense, find D. So in this example, risk-averse decision maker, it just means that your expected payment has to be the premium he want to pay. That's what it's about. Risk-averse, it really just means your expected payment would be equal the premium. Now, how do we calculate expected payment? In this case, expected payment is EX minus D. And we know the premium he want to pay is 2. So if we can calculate this part, then we can solve for D. Okay, so EX minus D in this case will be equal D to $10 because this is a uniform distribution. X minus D. Anything below D, below $2, you will not get paid. And in this case, since it's a uniform distribution between 0 and 10, so fx is equal to fx is equal 1/10 actually. So in this case, it's like this. Then we can solve this integral of this will be D to 10. Anyway, this will eventually we will get to this. If we solve it, it will be equal to 10D plus 12D squared. Then we equate this to premium 2. From here we can get D is equal to 3.68. So this is the process to solve this problem. It's not a difficult question. It's just you need to follow the logic and write out the equation and apply the expectation based on the deductibles and solve the equations eventually.